All right, so we had 5 down days last week, followed now by essentially 5 up days this week, up to a higher level than we started at last week when we started the week on a positive note. So, are we back? Are we back on this bullish trend? Not everything went up the same as you would expect. So we're going to talk about the rotations that occurred here this week and what kind of is driving this current bout of risk appetite and how that jives from a macro level to see whether or not the macro picture is starting to look improved or not, and how that justifies or how that rationalizes with our technical outlook, our market outlook. And then finally, we take a look at a stock in a sector that's offering a good trend trading opportunity. So let's go ahead and get started. Today is Friday, March the 15th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's get started with the market forecast on the S&P 500 first. Again, today's rally, and really, I mean, it wasn't a 5-day rally to offset a 5-day decline last week, but it was close. It was 4 out of 5 days. In reality, we had a small loss yesterday, and on Friday last week, it was pretty much a gain, even if we closed lower because of the rally off the low. So it was really 4 down days, 4 up days, and kind of some iffy days for that 5th day. But more than made up the loss, right? The close today more than rallied up above the highs of this week. In fact, the high here, 28.16, we closed at 28.22. So we got a renewed strong bullish posture. I mean, remember, we never did get a bearish posture, right? This was a weak bearish posture, but with an intermediate line not getting below 50, we never did get dark pink shading, which is when you have that when you really have a bearish posture going on. Obviously, it didn't come close to a red line, which is what you get when you get dark pink shading, right? Is that red line on the moving average. So we didn't get that. We just had, when you get weak pullbacks, even over here you had dark pink shading for a little bit. When you finally got the intermediate pullback, you got a red line over there. We're not close. We're not anywhere close to getting that right now on the S&P 500. So the near-term line's pulling down, but still in the upper half of the chart. We're looking at, will this be 5 days that the near-term line has been above 50. Didn't really stay up above 80 for very long, so we'll kind of keep our eyes on that to see if that leads to any weakness there. The typical pattern, right, is to get up above 80 and stay up there, right? The idea is to stay above 50 for 7 to 12 days and get up to 80 and ideally spend most of that 7 to 12 day window up there. The momentum line did fall down here with yesterday's drop, and that produced a bullish intermediate confirmation signal with a strong bullish posture and an oversold momentum line. That played out today with a bullish bounce. Even from the futures, we moved up higher. So, you have to move up now. These retracement lines that we were kind of keeping our eyes on, because we know at some point in time there will be that intermediate pullback. So we'll just kind of move this up to today's high. And then the fans, the Fibonacci fans, we will also activate that and move that up to today, because those are kind of our retracement levels and time frame. And if I were to throw on a few more bars here to the right, then you can kind of see where these lines are crossing. Now we're kind of past, so they were initially crossing right at here this March expiration, or right after, but now that we've continued up and haven't pulled back. We started to here, but didn't quite. Again, that was more of a shallow exhale because of how bullish we've been. We were flirting with that 78% Fibonacci retracement of the decline, right, of this decline bouncing back up, and today getting above that, just barely, but getting above that. Again, any pullbacks would be into those areas according to the crossing. There would be some support in these areas at this time frame, and then we're looking at beginning of April, a move towards 2640. Now, typically from the beginning of April from a seasonal standpoint, again, if I look at the seasonality chart, here we go, and then we'll look at price as a percentage here. You can see from the beginning of April, where we get some weakness here, and this is actually, let's go 20 years. You get some sideways action going on here, some relative weakness, but by the beginning of April, we typically, that's when we start a decent run. A little bout of weakness at post-June expiration. But then into the July expirations are usually when we peak for the year until the end of the year. That's the average, right? That's kind of the average move. You can see, we are well above average right now on a year-to-date basis, up to 12.5% for the S&P relative to where we typically are this time of year, kind of basically at break even. On average, we're at break even for this time of year. So yeah, we're potentially starting this run. That usually starts again. We're at March expiration, so could we get a couple weeks of weakness here, heading into those Fibonacci support areas, whether it's 2713, which would be 100 points plus down, or this 2640 area, which would be more of a typical exhale, right, and more of a an intermediate pullback that would get us down there. That's, I think, if we got down to 2713, we wouldn't get the intermediate line crossing below 50, but a move down to 2640 by beginning of April, obviously, probably would get the intermediate line down below 50. Most likely not down below 20, but down below 50, and set us up for this type of bullish intermediate low point. So, now granted, do we have to get that? Apparently, not enough people are in the markets yet. And that's why the pain trade continues, as we mentioned in our last video, continues to be to the upside. So as long as the pain trade continues to the upside, then who knows how long this strong momentum can last. You can see it's slowing. We're a lot closer to the 30-day moving average even with this bounce than we were over here. So we're losing momentum, and we're kind of going sideways. You can see the whatever concave shape of this line. It's not going hyperbolic. It's starting to go this direction, the opposite direction, which means it's slowing down. So, and we'll see, that's, it eventually does. It can't go up at this pace. That's a strong pace here. This is kind of your normal pace where it doesn't really go hyperbolic or in the other direction. This is nice and steady. We're starting to get to that mode right now, but considering that we've had this kind of a move, usually you'll kind of flatten out and then restart a new one. A new intermediate run. We'll see if that ends up being the case. As of right now, strong bullish posture, rising long-term market sentiment. You can see the Dow Jones not quite as bullish, not above those highs yet, still kind of being weighed down by some of its components. The Nasdaq is strong. It's probably more bullish than Nasdaq is than the others because we are kind of led by those FANG stocks. And then the Russell, again, not nearly as bullish. Not even close to 1600, and really not going up very much today at all. The S&P pretty much doubled the returns of IWM. So there's SPX, and then down here is IWM. So it's not really the most bullish when you see the broad S&P 500 leading, and then you have mid caps that are down on the day, and then small caps that are up just a little bit. So more of a narrow move when you're looking at it. And of course, we'll take a look at the sector rotation here in just a minute. Now, before we look at some other charts, a reminder, subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of your video. Click the red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells us you want us to do the video again. It's a quick, easy way to give us feedback. You can do that right now while you're watching. Also, down there, comment what stood out to you today in today's video. What did you get out of it? Comment down below for people who are coming to the video and the channel to check it out for the first time. Also, join our Daily Market Outlook email list. There's a link popping up there in the top right corner of your screen. Follow me on Twitter for more content like this between videos. Join our Market Outlook community that we've created on Facebook. Also, while you're here, 3 clicks. 3 clicks is what we're looking for. Click on this heart that will like today's Market Outlook tweet. Open up that window, click that like button. It also tells Twitter that you want them to push you our content. Same thing here, click on this image, takes you to our Facebook post. Like today's Market Outlook post there, share it with friends. And then finally this like button right here. So those 3 clicks. Remember, above the video is a link to our Market Outlook forums at marketscholars.com. You can also see it up here at the top. You have to participate in our forums, you have to subscribe to our site. And you can do that really easy by clicking on this link, where you can also, right below that, you can see the upcoming class schedule we have here for tomorrow, which is my Q&A session in the morning, and then back to our normal schedule here on Monday. All right, now let's take a look at the long-term view, and you can see how, this is as neutral as we were 2 weeks ago. Very, very small body, small range for the last couple of those weeks. Then whammo with a big move to the downside, and then bam, right back up to the upside. But when you look at these candles on a Heikin-Ashi standpoint, because remember Heikin-Ashi looks a little different, you can kind of see how both of these candles are considered transition candles, transition to a trend reversal. So we'll see. It's pretty noisy last couple weeks, coming off of a couple neutral candles, but you can kind of see how these noisy candles are actually the neutral, according to Heikin-Ashi. Now we can transition to continue, as I said before, you can transition into a continued move, a continuation move. It's not as common, but it can happen, as we saw here recently. So we can get bullish candles coming out of this, and we'll see if that ends up being the case here next week. You can see the Heikin-Ashi open for SPX, or for SPY, which is what we look at on that intraday chart, is at for next week. Let's see, it's going to be the midpoint between the open and the close here. So it'll end up being 277.94. So remember that when we look at the intraday chart. We're obviously right now trading at 281. So right now for next week we do have a bullish. Barring a move to the downside on SPX, we will have a bullish candle. So we'd have to trade below basically 278. Which again, like I said, is more than 3 points away. We'd have to trade below that level for us to get a lower shadow and get essentially at the very least another transition candle for next week. All right, so we'll keep our eyes on that. Let's look at the 3 green arrow chart, and you can see where now we have 3 green arrows again. The MACD giving us a green arrow finally today, which gives us shaded green with a green line. I remember that histogram at the bottom is because the moving average has gotten above its, the MACD has gotten above its moving average. So we're forming a new high, and obviously it's a higher high according to these oscillators. And the MACD is still above 0, so we're still bullish. Obviously we're above the rising 8-day moving average again, or above the rising 17-day. Are we going to stay above the 8-day moving average as long as we did last time? Probably not, right? That was kind of rare for us to be up above the 8-day. This is annoying when it does that. It was kind of rare for us to be above the 8-day moving average as long as we were. So don't expect that, and you can see we're not as far away from it as we got when we initially started this surge, when we really got up above the 8-day. And you can see how we started to grind closer and closer towards it before finally breaking down. Well, now we're popping up, but we're not popping up nearly to the same extent. So it won't take as long to get back down to 0. So keep your eyes on that. And of course, both the MACD and the stochastics are still much lower than their recent highs here. So, and we're already to higher highs. So keep that in mind in terms of divergences, which can occur at the end of intermediate moves. So we'll watch for that. I mean, obviously the MACD is well lower than that peak, and stochastics too is getting above 80, but not close to that 95, close to 100% where we were at before. All right, from an intraday standpoint, we did start lower on SPY because of the dividend. Excuse me, yeah, the dividend payment that came out here. So that affected things, but we did rally up to now. If you look at ES, which traded 24 hours and does not have the dividend, you can see we rallied a much higher high. So that's a little different story. We closed pretty bold. We closed above yesterday's high point on the futures and above all these other highs. Not quite the case, and you have to kind of zoom out here, but you can see we closed above all those highs on ES. Not the case in SPY because of that $1.23 dividend. So we didn't quite get up to new highs, and we also pulled back here at the end of the day, trading at 281.35. You can see here, even just in a little bit of time after hours, down just a little bit more, but not much. So we'll see what happens over the weekend. Remember that too, that Heikin-Ashi Open, the purple line here. It's not that. Let's gonna see if I can get here. There we go. So it'd be 277.95 essentially. So that's right there. That dotted line is not going to change anytime soon because the low point is not going to move. It's not going to move up anytime soon. It's not going to go down until we push it. So it's going to stay there until it moves all the way over here, right? Or we form a new lower low point. The high point is the one that can move up because we're really, really close to it. After pretty much forming the 4-week low point on Friday last week, we pretty much came close to forming the 4-week high point this Friday. So, you know, things change pretty quickly. But remember, if we trade back into this area, even to the halfway mark, it'd be a transition candle. And remember, if you look at small cap stocks, they are in the lower half of their chart. So the SPY is pushing up to new 4-week highs. QQQ, which is the NASDAQ, not just the NASDAQ composite, but the NASDAQ 100 is pushing up to new highs. Diamonds is at least in the upper half of the chart, but held back, like I said, by some of its components like Boeing. But small caps, which should be our most bullish asset class because it's got the higher beta, you know, it's still lagging and struggling near its midpoint. So we'll keep our eyes on that because that doesn't bode well for equities if small caps not leading the way you'd want it to lead the way. Usually large caps lead the way towards the end of bullish moves, not at the beginning. You know, if we were just starting at beginning, doesn't mean that we'd start a bear market. It just means that, you know, this intermediate run may be running out of that fuel that small caps initially gave it when small cap stocks was moving its way higher, right? If I were to go out here to, you know what, out to that the Christmas Eve low point, Christmas Eve right there, and I'll probably have to go out to like an hourly chart here to reduce or go a couple hours, so we can get it all in one chart. But there you go. So we were really pushing, trading up in the upper half of the chart, and that moved up the range with it. Now the range is stuck and we're not pushing anymore. In fact, we might be doing a little bit of a head and shoulders pattern right now. If we were to break below 150, would, you know, obviously be bearish for small caps and eventually bearish for equities in general. Let's take a quick look at the range and volume today. So remember, we did gap down, but we filled in that gap. So today's range was less than average. The volume was just a little bit above average at 81 million on quadruple witching. I put that in context here. 81 million shares, a little bit above that average. The range of under 2 points, 1.88, is way down here below average. So, you know, that 1% mark, we're in that 1% mark. We're not looking, any drops are not going to be, and this is not a bear trap, right? We're not going to be retesting December lows anytime soon, according to the technical indicators. We are now in this bullish trend according to that, as well as according to volatility, which closed right in the sweet spot of bullish territory. That's a good bullish close for volatility that we haven't been down here in quite a while. You get down there, you know, last time we dropped down to these levels was at the beginning of May last year when we started, you know, when that bout of volatility finally ended over there. So, you know, it doesn't mean that we can't get some volatility moves, some short dips to the upside. And then eventually that was your intermediate pullback last year that we're kind of looking for something similar now. But it does mean that this kind of volatility, we're past that level. We're past the type of volatility that would get us way up here, right? So that's a good sign. On a daily basis, you can see on a weekly basis, again, you know, getting down here, like we did last year in May right there, is a good sign that the trend now, this bullish trend, is entrenched. That any drops we get, again, will not be drops in new lows, will not be, you know, will not suggest that this is a bear trap like you might read if we do get a Fibonacci retracement, but it will simply just be pullbacks, nothing else, right? Pullbacks. And, you know, when the pain trade gets to the point where now all that late cash has come in, then the pain trade will be to the downside until you get the new buyers that are looking for that intermediate pullback. All right, so what do you think about that market outlook that we just came up with through our routine there? Do you agree with that? Disagree? There's that link popping out right there. Click that link. It opens up a poll. Hit either agree or disagree. If you click disagree, which is certainly fine, But I want to hear from you. I don't want to just hear what you think will happen, but I want to see, what are you seeing? What do you see on the charts? What indicators maybe that we haven't looked at? What other macro things are you seeing that would suggest that maybe we're either a lot more bearish than this, or we are full steam ahead, no pullbacks imminent at all? So let me know your thoughts with that down in the comment section down below. All right, well, let's now take a look at what's driving the price action, at least for this week. You can see it's a great week for crude oil, up 4%. Emerging markets lagged, started the week strong, lagged the last couple of days, and finished the week up. So it's a pretty decent return for emerging markets relative to developed markets. They had been pulled back down here, bounced back up. A good move today. Small cap stocks, however, not really showing the same gains. So down, up only 2% relative to 2.89% for the week. Of course, all these other high yield bonds, preferred stocks lagging behind as you'd expect. Agricultural commodities really rallied up here at the end of the week. So they were up to 2.3%. You notice on the other end of the spectrum, the dollar was down. So let's take a quick look at that dollar chart on the 1-year chart. Last week we talked about that kind of fake out move that we had last Thursday. Well, since then it's been on a steady decline, down every day since. Almost every day, up yesterday, but pretty much down every day since. So this bullish dollar story still not able to quite take hold, and it's something that we've been kind of looking at from and you can see this is pretty much this week right here. And we've been kind of looking at the dollars being more bearish, and you see that in its chart that you have. Now we also notice a little bit of a breakout this week in crude oil, and so far, you can see it on the Bollinger Bands especially, so far the breakout's held. So there's opportunity here for this to really move higher with that weak dollar. Now usually gold benefits from a weak dollar too, and you can see gold kind of fell down to this bottom end of all this volume. There's a lot of volume on gold here, so it's made a nice run to get to this point, and it's back into this volume channel, the 70% channel. So getting back up above, say 1320, would be really bullish for crude oil. So for gold, we'll keep our eyes on that. But I mean, this is a little bit of an inverse head and shoulders pattern developing. If markets are bullish, even though the dollar may be weak, if markets are bullish, you could see gold kind of fill in this vacuum and move down here towards this Fibonacci support. So this would actually have to be moved here. If I activate this, move it up to these levels up here. Brief little pullbacks here, but now we finally got a deeper pullback down to that 38%. And you can see your deeper pullback would be all the way down to that 78% Fibonacci retracement, that dotted line that I've put in there before. It's not as supportive as big a support level as these, but still is one to keep our eyes on. But again, we'll keep our eyes and see 1320. If we break 1320, then that head and shoulders pattern doesn't play out. So we'll keep our eyes on gold and how it's performing. With that weak dollar. Of course, emerging markets have been kind of, well, here, let's go to a long-term view of emerging markets. Here, 1 second. All right, so here's our long-term view, and so you can see we've had a battle weakness for a couple of weeks, but this week starting to bounce back up and getting back up above its 200-day moving average. We had closed a couple of weeks the last 2 times it closed above the 200-day moving average, it came right back down. We had basically a 2-week losing streak both times after having a good run to get there. So we'll see if this is now the breakout that holds, because we're really close to in fact, next week most likely you're going to get that golden cross where the 50-day will cross up above the 200-day moving average. From a news standpoint, you can see that we had quite a bit of news today. The Empire State Manufacturing Industrial Production. Empire State Manufacturing continues to get really weak. Now, this is a survey of business owners, so manufacturing in particular. And you can see the Philly Fed's the line here. That will be coming out later next week. But the bars chart is the Empire State, and it's been weak now for a few months. And the Philly Fed has actually gotten below 0. So these are these are contraction levels from this particular sector. And again, It's a soft data. It's not hard data. That's what the industrial production. Soft data means it's survey data. It's what people are answering their questions. Industrial production is more hard data. It's actual production. And you can see its year-over-year growth rate is slowing down too, and kind of breaking this trend line that we've had since that last global recession hit in 2015 and culminated in early 2016. We've been growing bullish on industrial production since then, but we've broken that trend line now and have been progressively getting a little bit weaker. So as a whole, economic indicators remain pretty weak. See, here was that global recession and what happened there. Over here is 2015 and into early 2016. You can kind of see the impact it had on U.S. indicators. Looks like we might be headed towards something similar right now. That was the industrial production. Now, one thing that doesn't get the JOLTS continues to remain strong. And the employment sector is this very, very strong sector in the economy right now. The consumer sentiment bouncing back up after a couple months of some weak numbers, so you can see bouncing back up there. I was surprised to see that my gas, when I went to go fill up with gas, that we were almost under $2 a gallon. So I mean that's a big factor actually in consumer sentiment, is gas prices, ironically. So I wonder if that has something to do with it. Treasury International Capital doesn't get a whole lot of publicity. It measures basically how much money is coming in, because money goes out from the United States because of our trade deficit, right? We have to buy all those goods from other countries in their currencies, so we have to exchange dollars for their currencies to buy their goods. Well, we have to balance our accounts. We have to have foreign currencies coming in and exchanging for dollars, so we can make that exchange and have a nice balance here. Well, that's what the money usually comes into our economy for our financial products like treasuries and other long-term securities, right? Well, if you look at the graph of this is actually the graph of just all treasuries, all net treasury, not just the long-term, but all net treasury international capitals. You can see the trend. This is the 4-month trend. This dotted line has been really negative now. It's it's down below zero. We peaked. We've been steadily moving lower. You can see we were up and down in 2016 before really taking off. Well, we're back down, and you can see the numbers are relatively low. Those are total capital flows. The net long-term flows, same thing here. We take a look at this line. You can see is also getting to its lower level that we've seen, the 4-month average getting to its lowest level that we've seen since that last global recession. And the absolute figure, this is last month's actually, this month's being up around 7 million, 7 million decline. But you can see even last month's one of the bigger numbers on a negative that we've seen in a while. So that's not actually a really good sign, because you need those money. Our trade, the balance of trade continues to be negative, very, very negative, right? So you can see here the 4-month average. See how we're getting actually progressively more negative, and we're not getting the capital, the increasingly bigger amounts of capital offset that. That's not usually a good sign, and that hasn't translated to rate high. I mean, that hasn't translated to the markets being extremely bearish. But you notice that the bond market's the stock market might be taking note of that, might not be taking note of that, but the bond market has been. You can look at the week. We broke down this week. And we're actually a smidgen below 2.6%. That's an important number. We broke down below all those lows by the end of the week. And then you look at rate cut odds are higher than they were a week ago. So that's kind of as a reflection. I mean, the bond markets in the futures market here for the Fed funds, they see those data points, whereas the stock market's not quite. Now, the stock market kind of is seeing it too, because we're kind of moving our way into more of these the international stocks outperforming, and large caps are outperforming. The money's moving towards safer havens. Now, it's also still moving towards FANG stocks versus value stocks, but you'll start to see value outperform. You'll see diamond outperform small caps and mid caps, as we saw today. You'll see real estate start to outperform when the market is, even though they might still be bullish on a bullish trend, the stock market, they are moving in that bullish trend towards other assets, right? The safe haven areas. Take a look at what's really performing well today. That technology sector had a great week, up 4.5%, even with a little bit of a pullback, was up 5% almost at one point. That was pretty much the only sector that outperformed the market. All the other sectors lagged behind, just to varying degrees. Healthcare was right there. Energy and financials are a little bit below it there at 2.5. Industrials, of course, we know why, with Boeing down, was negative on the week. And you can see materials and utilities lagging behind real estate. In fact, Brandon's sector selector rankings were updated here on the blog, so make sure you check that out here. And you can the Market Scholars, premium Market Scholar members can see that down there. I've updated this chart here, the 12 grid, to show the current rankings, and you can see, technology and utilities are up at the top of his list, whereas some of these others continue to be, even though they might have strong communication service, has a strong intermediate posture, they're really close to those moving averages. In fact, the energy, discretionary, material, they're right on it essentially, and industrial is actually a little bit below it, whereas some of these others are further up above. So the market itself is kind of slowing down. You can see which sectors are slowing down the most. Now these two sectors, energy and materials, they're the ones that we would expect, if the dollar continues to be bearish, to move their way up towards the top of this, both of these sectors. And you can see both your consumer sectors continue to lag behind. So it's kind of interesting to see that phenomenon right now, as we saw with consumer sentiment. You remember, industrials is a reflection of that industrial production figure, and the financials, that reflection of that Treasury International Capital. And as you can see, yields not rising anymore would also put pressure on that particular sector, especially if that yield spread continues to fall as it has been. All right, now let's take a look at a stock in that healthcare sector. That's one of the strong sectors up there, right? Along with technology. What was the other one? Utilities, technology and utilities. You can see healthcare maintaining some relative strength, bouncing back up here. AbbVie, one of those stocks in there that finally has got that bullish combination after dark pink shading and light green shading for all this time. We've got a dark green line. See, over here you got the dark green line, but you got the yellow line at the time you got the dark green. Here we got dark green and a green line. So bullish combination here to get a bullish posture with a rising, being above a rising moving average. You can see it's been bearish to the point where we are, we're still below the 50-day moving average, but we've got a nice little engulfing pattern developing here. And if you look at it on the Bollinger Bands, you've got some nice support developing there from a volume standpoint. Look at all that volume here. There's some, even if this doesn't work out, there's an obvious support down below these lows that you can put your stop order, knowing that if we do make our way up here towards 95, that's a pretty decent 14-point move for about a $6 risk. That's just to get to that resistance, much less start a new trend and start working its way up towards 100 or more. So, if it turns out to be more. So you can see it's a nice little opportunity. You can, from a DMI perspective, the plus just barely crossed above the negative, and it's also crossing here close to crossing the 25. Strong volume. If you take a look at the 3 green arrow trend, the 3 green arrows pattern, you've got this kind of sideways trend, 3 green arrows, and a green moving average, or above a rising moving average, and a spike in volume. So all good signs that we could start a trend. Like I said, even up to 95 would give us a good reward to risk ratio for the opportunity of buying. It's a relatively cheap stock at $81. Putting your stop order, again, an ATR or two below this low point here that preceded the 3 green arrows, which would be, if you look at the ATR for AbbVie right now, it's relatively low, so it's not like it's, we've based essentially here is what the ATR is telling us. We're still above that 2% mark, so we're not quite to the 1% where we're nice and steady. But you can see this is a relatively volatile stock compared to the broad market, and it usually doesn't get below the 1%. This is about as low as it gets. So there's opportunity here where, we've essentially, it's telling us that we've based. We're not as volatile anymore with the moves up to this 3 to 4% level. So the trend is kind of getting, there's potential for a trend to begin according to that that pattern there. So you put your stop over at 1.5, maybe 1 3/4 below this low point, the HER. So let's go 8 at V. You can see it's about 1.5 points here. Today's range is a little bit bigger. So you put your stop order right now. We're looking at the low point there at 77. So you put it at 75.5, and that gives us about, like I said, just under a $6 risk. With a $14 reward, less than $14 reward up to the upside. That's your 2-to-1 reward to risk ratio just for a move up to your next area of significant resistance, much less any kind of reward you might get going forward from there. And of course, your next set of 3 red arrows, if and when you get that, I guess you will at some point, but when you get your next set of 3 red arrows, would be the opportunity to then move up your stop order to 3% below that day's low point when we do get it. So, it's a nice trending opportunity in a strong sector that can be a strong sector no matter what kind of market we're in an area that's been beaten up and now may give us an opportunity to start to, as we saw in the sector rotation, in a sector that has been strong and remains strong and has that potential to continue to going forward to be strong. Alright, so that's what I had for you today. Now I want to hear from you. So remember to use that link up above the video on our blog that will take you to our Market Outlook forums on marketscholars.com. Remember, you have to subscribe to our site for free to be able to participate in our Market Outlook forums. But I want to hear what questions or comments do you have for me. Post them there. Reply to other people's comments that they might have if they open up, if you see other people starting new threads as well. Do you have any questions or comments about something I didn't cover in today's video? You can also post in that, open up a new thread. And like I said, whether I do it or any other market scholar, we can be able to keep the conversation going among us all in our forums. Thank you again very much for coming on and watching today. Have a great rest of your weekend, everybody, and we'll see you all on Monday.